the chance that the Fed will have to someday monetize the debt in order to keep interest rates manageable is rising by the day. And that is really the end game for gold. If the Fed someday starts monetizing the debt, then gold theoretically should go parabolic.
Hello and welcome back to Soar Financially, where we discuss the macro to understand the micro. My name is Kai Hoffman. I'm the @JR Mining guy on Twitter, and of course, your host for this conversation. And really looking forward to this one because we have a returning guest coming on. It's Jared Dillian, accomplished author, newsletter writer of the Daily Dirtnap, and I'm really looking forward to hearing his insight on what is happening in the economy. We got some PCE numbers and GDP numbers last week. It's Fed week as well. Sadly, we will be uploading and sharing this interview the day after the Fed meeting. So please put everything a bit into context. Give Jared some leeway if he might be off, if the Fed does something surprising on Wednesday. So give him some leeway there. But we're, of course, going to talk about some market trends. Last time we chatted, we talked about that there might be a recession happening, or that there will be a recession happening in 2024. We're about 5 months in now. The question is, where's the recession? Did the U.S. get away with it? What are some of the economic trends that Jared is witnessing and sharing in his newsletter? So we're going to get to the bottom of it all and to try to make sense of it all. That's the whole purpose of this channel. We're trying to be educational and informational. If you haven't done so, hit that subscribe button. It helps us bring guests like Jared on the program, and we really appreciate any type of feedback that you can give us, as long as it's constructive, of course. Really looking forward to reading it. And now, Jared. So, of course, we look forward to feedback.
I get my share of unconstructive feedback for sure.
Oh, there are some interesting comments, I tell you that. But it makes life definitely more interesting. I shouldn't be reading all of them, but they're definitely fun. But Jared, it's good to see you again. Thank you so much for joining me. It's a pleasure to have you back.
Yeah, it's great to be back. Thanks.
Let's dive right in. We last spoke about mid-December, December 12th. I think we uploaded our last conversation, and we have to discuss what has changed since then. Because we predicted, but I expected it as well, so I'm not taking myself out of there. We expected the U.S. to be hit by a recession by now. Like, the resumption was usually late Q1, early Q2. Now we're almost through Q2 here. 1 month left. Oh, sorry. Yes, one month left. What am I doing? May's the 5th month. Sorry, we got 2 months left in Q2. What am I doing here? But Jared, like, where do we stand? How's the economy doing?
Well, basically what happened was, the data got really soft. The economic data got really soft in the fourth quarter of last year. And, at the time I was probably in the middle of a trade where I was betting on lower short-term rates. And that turned out to be a good trade. And I closed out that trade in December of last year. And since then, the data has picked up again significantly. Honestly, the economy is pretty hot. We did get GDP of 1.6%, which is not hot, but the PMIs have picked up. Everything is generally picked up. And if I don't remember what I said in December, but during that soft patch of data, I was probably expecting that we would have a recession in 2024. Would have been wrong. And honestly, unless we get some kind of exogenous event, it doesn't look like it's going to happen.
We'll have to talk about why maybe it's not happening as well. Like, why is the U.S. dodging the proverbial bullet here?
I really don't know. The one thing I'll say is that the U.S. economy is unique among all economies in the world in that we have strong property rights, we have the rule of law, we have a culture of entrepreneurship. The U.S. has been outperforming foreign stock markets for the last 20 years by a lot, and that continues to this day. And, we, the United States, continue to be the destination for investment. So it turns into a little bit of a self-fulfilling prophecy. We have a strong economy, so people invest here, which makes the economy strong, which makes more people invest here. It's reflexivity. So I think that has something to do with it. That's my best guess.
Like, I'm sitting here in Frankfurt, Germany, and in Europe, of course, and I have to admit, there's a tad bit of jealousy when I look at the U.S. because the US seems to be doing a lot of things right, not everything, don't get me wrong, but it is funding the right projects. It's throwing a lot of money at the problem, which is not always a great solution, but it seems like it's investing in some of the infrastructure, bringing manufacturing, for example, of chips home to the US. So it is investing at home. Intel getting a ton of grants, $50 billion worth of grants to build 4 chip manufacturing facilities, just as an example. Is it just throwing money at the problem kind of situation, or do you see more, or do you call it like structural, like really outperformance versus maybe other countries?
Well, it's very simple. I mean, one main reason the U.S. stock market is outperformed is because the U.S. stock market is the only stock market in the world that has big tech stocks. We have Apple and Google and Meta and Netflix and fill in the blank. So we basically, we're the only place in the world that has these fast growing tech stocks. If you want to invest in banks and resources, then you go to Canada. If you want to invest in oil companies, you go someplace else. But here in the United States, we have the fastest growing tech sector. And, it's funny. I actually saw on Twitter today that over the last 30 years, the U.S. stock market has averaged 10.1% returns, which is above the long-term average of about 8 or 9%. So actually in the last 30 years, U.S. outperformance has been picking up speed.
That is an interesting tidbit, because I'm curious, because I'm looking at the future here a little bit as well, meaning AI revolution, and call it industrial revolution 25.0 or whatever you want to call it, Jared. But like in terms of AI, the US seems to have a head start versus other nations again as well. So that tech advantage seems to be sort of persisting. Would you agree to that?
Yeah, and a lot of the reason that is because tech is not really regulated. We have left the tech sector almost completely free from regulation, which enables growth. The other chart I saw recently, which was actually posted by a fellow German, Holger Schapitz, who you might have heard of, and he posted a chart of the performance of asset light companies versus asset heavy companies. And the performance of asset light companies has skyrocketed over asset heavy companies over the last 30 or 40 years. So, which gets back to the tech point that I was making before.
Yeah, it reminds me of the meme that was circulating maybe the last 12 months, last 24 months, is the largest car company doesn't own a car, Uber. Or the largest taxi service. Sorry, the largest taxi service doesn't own a car, which is Uber. The largest hotel operator doesn't own a single bed, which is Airbnb. Like things like that, those memes, exactly what you're mentioning here.
Yep.
There's non-asset companies that are doing really well. So,
Yep.
exactly. Let's break down maybe GDP and PCE. And sort of what the impact could be, because we're at Fed week, so I don't want to speculate too much about what the Fed will be doing, because by the time we air this interview with Jared, we might both be wrong on what we're asking and saying. I don't expect a big surprise, by the way, on Wednesday, but let's break down PCEs. Like it has been rising. The impact of what is driving costs here now? Like that's the question. And why is GDP down?
Well, inflation bottomed about 8 months ago, 9 months ago, and it's been creeping up a little bit. The Fed is looking at this. And if you remember, back in the fourth quarter last year, the market was pricing in 8 rate cuts in 2024. And now it's pricing in about 1 or 1.5. And really the only question is if we're going to get one at all, or if we do, are we going to get it before the election? And I tend to think that we're going to get one rate cut before the election, which will be a policy error. I think that would be a mistake. And I think particularly if Biden gets reelected, we're going to get rate hikes in 2025. I do expect inflation to reaccelerate. There's been some interesting articles about how Donald Trump's economic team is crafting some policy to actually reduce Fed independence in a myriad of different ways. And up to and including allowing the president himself to participate in the setting of interest rates. So this goes back to Trump's first term, 2016 to 2020, when Trump interfered heavily with monetary policy, commented on Jay Powell's leadership pretty consistently. And if Trump gets reelected, you can expect a strong downward pressure on interest rates and a reaccelerating of inflation.
Are interest rates the real problem right now? Because it looks like the GDP growth of 1.6% is not outrageous. We had much higher GDP growth the quarter before, but the economy is still humming along. Like there are no big cracks yet, right?
Yeah, that's pretty
So
amazing because, we had a period of about 10 years in the 2010s when interest rates were zero, and the prevailing wisdom at the time was that the economy could not tolerate higher interest rates. So, I think when the Fed started hiking 2021, they hiked to 1%, they hiked to 2%, and people very quickly expected a recession. And here we are with Fed funds at 5.5%. And as you say, the economy is still humming along. It seems to be tolerating higher interest rates pretty well. So I don't, it could the Fed hike to 7% in 2025 and not get a recession? I guess that's very possible.
depends a bit on the election outcome, I would assume as well, based on your previous statement, and see if Jerome Powell is still in charge at the Fed come what is it, November 8th, I believe, the day after, or maybe January 10th, as soon as the a new president is being inaugurated.
Yep.
I think. Jared, we GDP and we have to talk about deficit spending. Sorry, it's like I was trying to make the GDP to debt ratio and the debt conversation, and deficit spending, how that is playing a role in keeping the U.S. afloat. Obviously, a deficit of $2 trillion is not sustainable. The question is, like, how is it keeping the economy afloat and above water and the head above water right now?
Well, I don't think we're getting a lot of growth per unit of debt. For a $2 trillion deficit, we're not getting a lot of growth out of it. We have this sort of diminishing marginal utility of debt, and it's if you want to talk about debt and deficits, we've added $11 trillion in debt since the pandemic, and it hasn't accelerated growth at all. So I mean, this is a really long conversation about debt and deficits in general, and getting back to the election. It really seems like whoever gets elected also doesn't care about debt and deficits. So this is going to continue into the future. I posted a thread on Twitter a couple of weeks ago talking about gold, and I know I'm skipping ahead here. I know you want to talk about gold, but the chance that the Fed will have to someday monetize the debt in order to keep interest rates manageable is rising by the day. And that is really the end game for gold. If the Fed someday starts monetizing the debt, then gold theoretically should go parabolic. So,
Jared, can I quickly ask you to clarify, like, what does monetizing the debt mean? It sounds like a very simple saying, but what does that mean, and maybe what are the implications directly?
well, I'll explain the mechanics of it. So, let's say we're running true $2 trillion deficits, which go to 3 trillion, which go to 4 trillion, or whatever. And the bond market is unable to handle the supply of bonds, and the auctions get worse, and interest rates go higher. And we reach a point where the economy can't tolerate higher interest rates. So the executive branch, the government, says to the Fed, hey, can you please peg the yield curve at this interest rate? And this has been done before. This was done in the 30s and 40s. The Fed pegged the yield curve in order to keep interest rates at a manageable level. So what the Fed is essentially doing is buying an unlimited supply of bonds at a particular interest rate in order to keep interest rates low with printed money. So money supply increases, and that's pretty much it. So.
They've already allowed banks, or they've changed some of the rules so banks can buy bills or are being forced to buy government bonds as well. Is that something that sort of factors into that as well, into that discussion?
No, I think that's a separate issue. Yeah.
Gotcha. I know it's like we're talking here on Monday afternoon, my time, or Monday just around noon or right after lunchtime, your time, Jared. There, but the Treasury is putting out its refunding announcement later today as well. Do you expect any surprises from that? Do you have that on your radar screen at all?
No, I don't. It's I tell you what, there are times when I do pay attention to that, but I'm not at the moment. So
No. Like that like my next question would have been, of course, what's the impact on bond yields of, for example, in the 10-year going to be moving forward? And we're sitting at 4.6% roughly for the 10 years. Like how do you see bond yields developing?
well, I think over excuse me, a long period of time, 2 to 5 years, I think you can expect bond yields to be higher. That would be my forecast because of the supply issue, because of the deficits. In the short term, I think it's possible if we get a recession. I think it's possible for 10-year yields to get to 3.5, 3, maybe even 2.5 if we have a severe recession. But doesn't seem like that's going to happen. But like I said, I think in the long term, 2 to 5 years or more, you can expect higher interest rates. So
Would you agree with the term or me saying that we're in a stagflationary environment already, or are we headed that way based on just recent PCE and GDP numbers?
I've seen that term thrown around a lot. People love to use the word stagflation. I mean, if we are in stagflation, this is the first inning, right? Because stagflation is really it's the old misery index. It's inflation plus unemployment, and inflation is still not super high, at 3.5%, and unemployment is not high. So to get back to 70s level of stagflation, you would need inflation to be significantly higher, and you would need unemployment to be significantly higher. So
Do you see that changing at all? Do you see those cracks, especially on the unemployment side? Like, what could drive unemployment higher right
I
now? Is
have
there
no
anything?
idea. I have no idea. It's a mystery to me. And the interesting thing is that we've seen some layoffs. The default rate is going up for corporations, not significantly, but it is going up. Credit is deteriorating a little bit, but the labor market remains pretty bulletproof, and that's been the one mystery to people throughout this 22 months of an inverted yield curve, which, by the way, is the longest we've had an inverted yield curve without having a recession. So this is a real puzzle for me and for everyone.
I think it is for everyone, Jared, because nobody really knows what is happening and nobody understands it. Like, why? Like, why aren't we in a recession? Like I personally can only account it to the deficit spending and the grants that are being offered, and maybe trying to tidy over some of the potholes in the road before they get too big. But again, those are only temporary fixes. The only like proper investment I see in the US right now, because I was there a few times this year already, is investments in infrastructure, and that's airports. I don't see much else. I'm not sure if you share the same what do you call it, like the same perspective or the same observations here, but I'm grasping at straws here trying to explain it. All right.
I don't know.
And you seem to be at a loss of words as well. um, so maybe let's change momentum. Then you brought up gold in an environment where the Fed might have to monetize the government debt, and gold has risen dramatically. It's been a violent move for a precious metal, and for a metal and a commodity that's over 5,000 years old. 25% since March, pretty much. We have maybe you have an explanation, Jared. What has led to that massive breakout? Is it just technical, or is there more to it?
Well, partly it's technical. I mean, we broke out of a 13-year consolidation, and part of it is buying from East Asia, from China and India and other places. And part of it, I think, is the threat of monetization. I think that's part of it. And, a lot of people have noticed that the correlation between gold and interest rates is decoupled. Um, now we're getting higher interest rates and we're getting higher gold prices. And if you think about it, and this is one of the things I mentioned in my thread, which is that higher interest rates actually increases the probability that we will one day monetize the debt. So which should be positive for gold. So you're actually seeing positive correlation between gold and interest rates, which I haven't really seen in my career before.
And we can even throw in the US dollar here. Like the US dollar hanging in there. I'm just looking at the DXY index. I just pulled it up. 105.5. It's stable. It's oscillating between, what is it, 103 and 106 on a daily basis, depending on when you look at it. So how does that factor in? Like, why is the US dollar still holding up in that regard? Shouldn't it be way lower?
I don't think you're going to get a material change in the dollar until the election. And I think if Biden wins, you're going to get the status quo. You're going to get a marginally higher dollar. And I think if Trump wins, the dollar will collapse. I think it will utterly collapse if Trump wins the election. So
What I have to ask Jared, like, why is that? Why do you think that happens? Because the economy is going to break out. There's more trust in, again, the U.S. economy, or why would that be the case?
well, Trump actually explicitly says that he wants a weaker dollar to facilitate exports and to stimulate manufacturing. And, while he was president in his first term, he talked down the dollar pretty significantly, probably to the tune of about 10% or so. And the same is going to be true this time. Um, Also, if he getting back to what I talked about earlier about um, sort of weakening central bank independence, that is dollar negative. So Trump is for sure negative for the dollar all the way around.
Well, he did a good job. He talked the Dixie down to 90 at one point during his during his term. So uh, he has managed that because he wants to make the U.S. more attractive for investment, I suppose. And but that makes commodities more expensive on the importing side, like raw materials. And maybe we can talk about that. Like, how does that theory work out? Yes, it is maybe cheaper to produce in the U.S., but if you have to buy everything from abroad, or not everything, but a lot of the raw materials you have to bring into the country at a higher cost. Like, how does that balance out, Jared?
Well, that all of that is true, but ultimately, a weaker currency is harmful to U.S. manufacturers because they don't have to compete as vigorously against foreign competitors, right? And so if you don't have to compete as vigorously, then you become weak and flabby and uncompetitive and ineffective. Whereas a weaker currency actually strengthens foreign competitors because they have to be lean and mean in order to compete in an economy with a stronger currency. So, the intent of it is to benefit manufacturers, and it's really a matter of short-term gain and long-term pain. It benefits them in the short run, but it hurts them in the long run.
What was really interesting to see was the continuation of MAGA, making America great again, meaning the onshoring trend. Okay, um, it is happening. The U.S. wants to bring a lot more production home, and it wasn't since Trump, but also the Biden administration is saying the same thing. We want to make. They're not using the same slogan because that would be blasphemy. Obviously, that wouldn't work for them. But they're pretty much saying the same thing. Like, we want to produce more at home. And my question is, how does that sort of factor into the prices and inflation?
Oh, I
Um,
mean, it's absolutely inflationary, and I would love to bring back the period of globalization from 2003 to 2006, when we were trading freely around the world, and we had incredibly low costs for imported goods. I'll tell you a quick story. When I moved to South Carolina in 2010, I went to Walmart to buy a doormat, and they had a big pile of these rubber doormats for $4 a piece. I looked up the doormat on Walmart about 6 months ago. That doormat is now $44. So, in over the course of 13 years, it has gone 11x, and a lot of that is because that doormat is now produced in the United States with expensive labor costs and expensive infrastructure and everything else. So,
Wow. Okay, that's exactly what we can expect if that keeps happening. And chips production in the U.S. Yes, it's not very people intensive, but it's just higher costs all around. Like, doesn't mean if
yep.
it's a truck, like all the supply inputs are higher, obviously. Let's talk gold a bit more, Jared. And really like how you sort of forecast, of course, a higher gold price based on debt monetization. But we need to talk about what is really driving prices right now. Is it just is it central bank buying, Jared? Like, it can't be that. Like, we talked briefly, like, put aside the technical breakout. but where's it headed? And I've had guests on that have been saying it for 10 years that gold is ripe for a breakout, and it hasn't happened until recently. And many people still don't believe it. Like, how real is it as well?
Oh, it's absolutely real. Yeah, it's, I mean, like I said, it's a breakout from a 13-year consolidation. Um, this is the way I'm trading it. I'm long, and I think gold will get up to about 2,500 or so, at which point we'll get about a 10% correction. And I plan on hedging my position during that correction. And after the correction is over, then who knows? Like virtually unlimited upside. But that's just the way I'm playing it technically. We got up to 2430, so there's going to be a little resistance around 2430, but that's the way I'm looking at it.
I'm curious, like, what kind of I'm looking for the right euphemism here. It's like, what kind of shocks are you looking for when it comes to the gold price? When you open the newspaper in the morning, or you open your iPad, you go to ft.com or bloomberg.com, what are you looking for that could potentially hurt the gold price and set off a correction? And I don't want to give away the answer that I'm personally thinking of, is Iran and Israel make up, and there's peace in the Middle East. So I'm curious what you're looking for.
Well, that would definitely do it. But really, I focus on sentiment, and if sentiment around gold got really hot, if my neighbors were coming up to me and telling me they were buying gold, and if I was seeing it on the front page of USA Today and stuff like that, then that would make me reconsider my bullish position. So.
Appreciate you mentioning that. It brings me to an example. I have a friend in the US who's a teacher, and like, we often chat about the markets, how my business is doing, and things like that. And I told him, it's like, well, my business is doing okay, but we're trading at all-time high gold price. And he's like, what? Really? He wasn't aware of it. Hasn't heard it. Like,
Yeah,
mainstream media
exactly.
doesn't report it. And he's
Yep.
actually quite investment savvy. He used to work at a regional bank before he became a teacher. And he said, I just want to change the pace. I want to do something different. So he's actually well tuned in into what's happening financially in the financial markets. No clue. Like, I
That's the
don't mean
best
that
news
to,
I've
like,
heard all day. That
but
is
it's it's
amazing
the
news.
perfect example to what you've been saying. Like, mainstream media does not report about it, and the question is why that is. And I don't want to be a conspiracy theorist, but I've had guests on 2 years ago that said, "Oh, if the gold price explodes, the U.S. is in deep, deep trouble." Right? So, is the U.S. in deep, deep trouble at $2,400 gold? And it doesn't seem like it that way. But why is there such a hush hush campaign? Like, I can't explain it any other way. By the way.
I mean, I just think it's the natural undulations of sentiment. I mean, if you go back to 2011, the last time that gold peaked at 1900, there was a huge amount of gold bullish sentiment. Like, people were buying off of APMEX. You had those cash for gold stores that were opening up in stores. I mean, it really became like a frenzy. So you needed 13 years to work off that bullish sentiment. And now gold is trading close to all-time highs. And like you said, nobody's talking about it.
We've established the US as a fairly strong economy, and it's still humming along. It's fairly hot, actually. So we have to look at some of the other commodities. Copper has been running recently. We're trading at 460 a pound. We're close to $5 again. Fairly high levels for that base metal. How do you see copper and other commodities behaving in the next 6 months?
Yeah, copper is one of the best looking charts I've seen out there. It's a great looking chart. Um, the only, oil is doing okay. Like, the only commodities that really haven't responded to this um, bull market in commodities that just started are the ags, like corn, wheat, soybeans they're still pretty close to the lows. They haven't really turned up yet. But once like I said, my core thesis is that we'll have a pickup in inflation going into 2025. And I think you could do worse than buying an ETF or ETN that was a basket of commodities that would give you exposure to the whole index.
We have to talk supply and demand, and there was just a big merger, or possible merger, or an offer announced. BHP potentially buying Anglo American. They're willing to potentially sweeten that offer. Um, how is that impacting? And what does a deal of a $40 billion magnitude tell you about the underlying fundamentals of the commodity?
Well, I mean, basically, to me, it's a bullish sign. Glencore going public in 2008 was a bearish sign. You usually see IPOs at the top, and you usually see mergers at the bottom. So this is a very bullish sign to me.
Does it have anything to do with the copper price? Because I think after that deal was announced, copper actually jumped, just putting some emphasis on the current supply and demand dynamics.
Well, the thing is that it takes on average 20 years to bring a copper mine into production. 20 years, right? Demand responds much more quickly than that. So if we have a pickup in demand, it's not like we can respond. It's not like we can respond instantly by increasing more supply. It takes decades to bring that online. So, if this is the beginning of a bull market in copper, it's probably got a long way to go.
Jared, we've covered a lot of ground here. Now I'm curious, like, is there anything you're following outside of mainstream media or like Wall Street that is of interest? Any trends that you're following that only your readers know right now?
Private equity is probably the big one. I'm very bearish on private equity. I think we have a private equity bubble. We've seen Tony Robbins get into private equity, Kim Kardashian, athletes, celebrities. This is not the sort of type of things that you see on the lows. You're seeing deals get done at insane valuations. It's, I could go on for a long time on private equity, but I think this is big. I think it's a bubble, and I think it poses systemic risks.
Where's private equity seeking its returns right now? Then, like, what is it attracting? Is it still chasing the tech stocks? Is it trying to find a second Nvidia?
No, in fact, there's 17,000 private equity firms in the U.S., and there's so much competition for deals that they've gone further and further down the food chain, and now they're rolling up dental practices and pizza parlors and laundromats and car washes and stuff like that. It's reached the point of absurdity.
Interesting. I'm curious, like, again, an observation as I was traveling to the US quite a few times. And I'm not sure if you're familiar with Voodoo Donuts or you might have heard of it. It's a Portland donut bakery that started with one little shop. The last time I was in Portland about 5 years ago, it was only one little shop. Now you can find it at the Denver airport. Okay. It is, I think, that absurdity, which is driving me nuts personally, because I like those little shops, like a Voodoo Donut that has that one location, historic, and then it just explodes. Is that private equity driven? Just curious.
No, that's not private equity driven. No, no.
Okay. No, I'm just curious if they bought into Voodoo Donuts. That is just an example, like, of
No.
how they're expanding it and pushing it, and because that's driving me nuts. Just a personal anecdote, because it takes away the uniqueness of a certain place.
Yeah.
Driving me insane. Jared, I think we've covered a lot of ground. I've ran out of topics, I think, to discuss with you, which is a good thing. Anything we haven't covered yet? You touched on oil briefly. Should we go there real quick? Oil, like, where do you see demand, and where do you see the price going?
I don't really have a view on oil at the moment. I don't.
It's too tough to predict, quite honestly. I have a hard time with it personally. I think we should be trading right around $100, just based on what is happening in the Middle East. But then I keep hearing the US is self-sufficient and we should be trading closer to 50, which I was like, that's a tough one to believe right now as well. So I think the truth is somewhere in between. So, okay, let's leave that topic aside. Jared, you've written a fantastic book. You tell us a bit more about it. Like, how does it apply to our everyday lives?
Well, the book is No Worries: How to Live a Stress-Free Financial Life. And I wish I had a copy of it here. I could pull it up. It's a fantastic book. Basically, I look at personal finance through the framework, not of how to get the most money, but how to reduce your anxiety, how to live a stress-free financial life. And I talk about it from a philosophical standpoint, but I also get into the weeds on things like credit cards and mortgages. It's a great book. Please pick it up. It's got 484 reviews on Amazon, and 87% of them are 5-star. So
Oh, phenomenal. And I saw you also hosted a conference recently. So the question is, what was the most asked question there, Jared?
There wasn't really a most asked question because I have speakers from a bunch of different disciplines, so it wasn't.
Or maybe like the most pressing, like people wanted an answer to, like what was the most pressing topic or that one buzzword that kept coming up?
Well, I can tell you the conference the year before, it was AI. I don't think there was one really at this conference. So
Interesting. Like, because trends are changing and they're changing quickly, or ever like quicker than ever. Like we talked about with another guest here on the channel, we talked about EVs and the lessening of interest, or decrease, or lessening is not a word, decrease of interest in EVs and slowdown in markets. So all those trends. That's why I'm always interested, because every conference has a bit of a theme, and there's that odd buzzword that keeps coming up,
yep.
depending on type of conference. So fantastic. Jared, where can we follow you? Where can we follow your work?
You can follow me on Twitter at Daily Dirtnap, and my personal finance website is jareddillianmoney.com. There's a bunch of resources there. And if you want to subscribe to the newsletter, it's dailydirtnap.com. And just reach out to me. And if you mention the podcast, I'll give you a discount.
Phenomenal. Appreciate that. Thank you so much for that. Jared, really appreciate you joining us here. Always a pleasure chatting with you. And let me do my outro real quick and thank everybody tuning in. I hope you found this conversation insightful and educational. If you didn't, leave a comment down below. What can we change? What kind of questions can we ask? Our purpose, the purpose of this channel, is to make you better investors. We're not giving out investment advice, but we're trying to make sense of the macro to understand the micro. Please subscribe to the channel, leave a comment, leave a like, and we'll be back with lots more here on Soar Financially. Thank you so much for joining us.